Hello, this is Wilfred Hahn, Co-Chief Investment Officer and Chairman of Hahn Investment. Today is April the 8th, and as we usually do, we like to bring you a monthly update, how markets have done and how have portfolios done. So let's firstly go to market performances. How have markets done around the world this past month? It was relatively mixed this last month. Bond markets in general did not do so well. Generally off all around the world. However, with the Canadian dollar being so weak, some of the bond performances did a little better internationally. On the equity side, the Canadian equity markets were down somewhat, 1.88% for the month. And generally, stock markets in the major developed markets went sideways to down modestly. And again, international assets benefited from the Canadian dollar being somewhat weakish through the month of March. And the same kind of story continues with commodities. Oil was weak again last month, 2.5% decline. That brings the total decline for oil in in Canadian dollar terms to 46% decline, that being again from a year ago. So pretty much a blended perspective. Some international assets did pretty well, such as Chinese stock market and so forth. But by and large, somewhat of a turn from the ebullient January that we had. I think everybody will recall how strong both stock markets and bond markets were at that point in time. Year to date, might even be better to look at 12 months to date. Bond markets have done as much as 21% returns, those being international ones. And there again, the Canadian dollar contributed about 9.5%, almost 10% of that 21%. And also equities around the world did very, very well. Canada is up about 7% only, hasn't gone back to its former high of last year. Other international markets did really well. If you look back on a 12-month basis, as much as 29% gain to date, 12 months, that being for the S&P 500. Well, how did that all impact our portfolios? Let's look at performance there. We tend to show three of our more modest conservative portfolios, and they have done very well year to date. And again, everyone will recall how strong January was, quite incredible. And we, of course, did mention to everyone that can't be sustained indefinitely, and that we were going to be expecting some pullbacks. And February rolled around, and lo and behold, it wasn't very much of a pullback. All the portfolios still were positive returns, although very, very minor. This last March, however, most things turned down very mildly, though, I will say. And so year to date, we're still looking at some very, very good performance figures, anywhere between 7 and 8.25% for the midline of these conservative portfolios. We should actually be showing our global portfolios and our new opportunity focus portfolio. All of those have done much, much better than the core, more conservative portfolios. They all have returned above 10% year to date, so that being over a 3-month period, and that's quite incredible. So by and large, we're very happy with the performances in the portfolio so far. They all have been outperforming. And again, this last March, the period for which we're reporting, again, all the portfolios outperformed, although only mildly so. But nonetheless, things are going our direction. Want to talk a little bit about interest rates before we come to a conclusion here. Everybody's wondering, when will interest rates go up? And everybody does realize also at the same time that interest rates are at very, very low levels. We've often commented upon that phenomenon. In fact, interest rates in some countries are their lowest of all history, more than modern history, that is. And so that's crimping certainly returns for many, and we've long talked about a global income crisis transpiring in the world, and indeed it is, and we continue to forecast that it will continue. And so back to the question, when will interest rates rise? The chart that we're showing you here shows you how persistent economists and portfolio managers have been over the last number of years, in fact going back almost 5 years now, always expecting interest rates to come up. And of course the big surprise, particularly here in North America, is that interest rates generally have not gone up. In fact, they've continued to fall back to prior lows, and economists have been frustrated in their forecasts for interest rates going up. And again, as we've talked about going into 2015, the same kind of situation prevails. Economists are warning everybody, as they have over the last 5 years, that interest rates are going to be going up on a more permanent basis. So we are seeing a bit of a replay of that again. The American economy is turning out to be weaker. That was an expectation of ours, and we had been counting on at least one more bond rally into the middle of the year, and that seems to be transpiring. We'll have to see how it plays out over the next couple of months. On the equity side, of course, equity markets have done well also because interest rates have fallen. However, we're starting to see now some differences in past trends with respect to earnings, and earnings are starting to come off somewhat, especially U.S.-based firms as their currency has gone up. Translation of their foreign revenues and profits have been diminished. And so largely the profit declines that we've seen so far in the corporate sector in the U.S. have been attributable to that. But we're on the watch for any other kind of a deterioration, because that would have to mean that we'd want to take a more conservative approach. So bottom line here with interest rates, want to emphasize that that's one of the themes that we think will be an enduring one for many, many more months, certainly years. And it's one of the reasons why all of our portfolios yield much above the benchmark for those portfolios. In fact, some of our portfolios, particularly the global line of portfolios, and even also the special opportunity focus portfolio, they have throw-off cash yields as much as almost double for the one income portfolio, but many of them 40–50% above. So you can see that we're wanting to rely very much on income wherever we can get it. Income, there is a shortage of it, and everybody approaching retirement age, of course, would like to have supplemental income coming off of their portfolio. So that's an area that we will continue to emphasize. Coming to a close, we always like to point out articles that we've been writing, and so we suggest that please check out our website. A couple of new publications have just come out recently. One of them is the portfolio update that would have just come out a couple of weeks ago, and you'll be interested in that if you wish to know some of the major decisions we've made and some of the active strategies that we pursued, adjustments that we've made to the portfolios. And also a recent article published on ETF.com written by Tyler Morty, who's our president, and it talks about reasons why one should underweight U.S. equities, looking at the equity class overall. So that's our update for this month. Thank you for joining us. See you again next month. Bye-bye.